The market just went through a brutal sell-off. Stocks that were up huge earlier this year got absolutely crushed. But here's the thing. Some of the best buying opportunities come right after the panic selling stops. Today, I'm breaking down 5 momentum stocks that got hit hard but still have serious growth catalysts ahead. These aren't speculative gambles. These are companies with real revenue, strong market positions, and clear paths to recovery. We're talking AI infrastructure, data center power, Bitcoin leverage, enterprise software, and cloud collaboration. Let's dive in.
First up, Micron. This is the hidden AI infrastructure gem that Wall Street keeps overlooking. While everyone's been obsessing over NVIDIA and the GPU race, Micron quietly dominates the AI memory market. Specifically, high bandwidth memory, or HBM, which is the bottleneck for AI chip performance right now. Here's why this matters. Every AI data center needs faster memory to keep up with GPU processing speeds. Micron supplies HBM to NVIDIA, AMD, and other chip makers. Without Micron's memory, those expensive AI chips can't run at full capacity. The numbers back this up. Micron is projecting a 32% compound annual growth rate over the next 5 years. That's not hype. That's driven by structural demand from AI infrastructure build-out. Recent sell-off? Yeah, it happened. Semiconductor stocks got hammered on concerns about AI spending slowdowns and inventory corrections. But here's the reality. Data centers still need to be built, and every single one needs high bandwidth memory. Micron's entry zone after this pullback makes it one of the most compelling AI infrastructure plays you can buy right now. This isn't about betting on a new technology. It's about supplying the picks and shovels for the AI boom that's already happening. The risk? If AI spending actually does slow down significantly, or if competitors ramp up HBM production faster than expected, Micron will feel it. But long-term, the memory bottleneck isn't going away.
Next, Vertiv. This is the stock nobody's talking about, but it's sitting on a 60% order backlog surge. So what does Vertiv actually do? They provide the critical infrastructure that keeps data centers running. Power systems, cooling solutions, and thermal management. Basically, when you build an AI data center, you need Vertiv's equipment to make sure it doesn't overheat or lose power. And here's where it gets interesting. Vertiv just reported that their orders are up 60% year over year. That's not a typo. 60% growth in orders. Why? Because the AI data center boom isn't just about buying GPUs. You need massive power and cooling infrastructure to support them. Think about it this way. NVIDIA sells you the engine. Vertiv sells you the cooling system and power supply so the engine doesn't explode. Both are critical, but Vertiv's been way less hyped, which means it's been flying under the radar. Zacks just ranked Vertiv as a #1 strong buy, citing this exact infrastructure tailwind. The company's positioned perfectly at the intersection of AI build-out and data center expansion. The recent pullback in tech stocks hit Vertiv too, even though their fundamentals are accelerating. If you believe AI infrastructure spending continues, and it will, because these data centers take years to build, Vertiv is a direct beneficiary. Entry zone after the sell-off? This is one of those rare moments where momentum meets value. The stock got cheaper, but the business is growing faster than ever. The risk? Vertiv is tied to data center CapEx cycles. If hyperscalers like Microsoft, Google, and Amazon suddenly slam the brakes on infrastructure spending, Vertiv's growth slows. But right now, all signals point to continued build-out. Number 3, Riot Platforms. This is pure Bitcoin momentum with a strategic advantage. Let me be clear. Riot is a Bitcoin mining company. If Bitcoin goes up, Riot amplifies that move. If Bitcoin crashes, Riot crashes harder. This is not a diversified business. It's a leveraged bet on Bitcoin. But here's why Riot is interesting right now. The company holds over $2.2 billion worth of Bitcoin on its balance sheet. That's not just mining revenue. That's a treasury position. So when Bitcoin rallies, Riot gets a double boost. Their mining becomes more profitable, and their Bitcoin holdings appreciate. The recent crypto sell-off crushed Riot, along with everything else in the space. But if you believe Bitcoin has more room to run, whether from ETF inflows, institutional adoption, or macro tailwinds, Riot is one of the most direct ways to play that momentum. Here's Riot's edge over other miners. They have some of the lowest power costs in the industry because of their strategic facility locations. Lower power costs mean higher margins, which means they can survive downturns better than competitors. Entry zone after this pullback? If you're bullish on Bitcoin and want equity exposure with leverage, Riot at these levels is compelling. The risks are massive and obvious. Bitcoin is volatile. Regulations could tighten. Mining difficulty increases. Power costs could spike. This is a high-risk, high-reward trade. If Bitcoin doesn't recover or goes lower, Riot gets destroyed. But if Bitcoin rips higher, Riot could multiply those gains. This is not a core portfolio holding. This is a tactical momentum trade for people who want crypto exposure in a brokerage account.
Number 4, Salesforce, the 12-year market leader in customer relationship management software, now supercharged with AI. Salesforce dominates the CRM market. If you're a sales team, marketing team, or customer service department at any mid to large company, you're probably using Salesforce. They've been the category king for over a decade. But what's changed recently? AI integration. Salesforce launched Einstein GPT and Agentforce, AI tools that automate sales workflows, generate customer insights, and handle support tickets. This isn't vaporware. Enterprises are actually deploying these tools, and it's driving renewals and upsells. Analysts are projecting 29% upside from current levels. Why? Because Salesforce is trading at a discount to its historical multiples despite accelerating AI-driven revenue growth. The market punished the stock during the tech sell-off, but the fundamentals didn't break. Here's the setup. Salesforce is a proven, cash-generating machine with sticky enterprise contracts and now a legitimate AI story on top. This isn't a speculative AI startup. It's a mature software giant layering AI into an already dominant product. Entry zone after the pullback? For investors who want exposure to enterprise AI without the risk of unproven business models, Salesforce is one of the safest plays. The risk? Enterprise software spending could slow if we hit a recession. Salesforce's growth is tied to corporate budgets. Also, competition from Microsoft, HubSpot, and others is real. But Salesforce's moat, its installed base and ecosystem of integrations, is deep. This is a quality momentum name that got unfairly punished in the sell-off. If you're building a tech portfolio, Salesforce belongs in it.
Last one, Atlassian, the oversold contrarian play with 66% analyst upside. Atlassian makes Jira, Confluence, and Trello, tools that software teams and project managers use every single day. If you've ever worked at a tech company, you've probably used at least one Atlassian product. Here's what makes this interesting. Atlassian's cloud value proposition has tripled in recent quarters. They're migrating customers from on-premise licenses to cloud subscriptions, which means higher margins, recurring revenue, and better retention. But the stock got absolutely crushed. Why? Growth concerns, macro fears, and rotation out of high-multiple software names. Wall Street overreacted, and now Atlassian is trading at levels that imply the business is broken. It's not. Analysts are modeling 66% upside from here. That's not a moonshot. That's a recovery back to fair value based on the company's actual growth trajectory and cloud transition progress. This is a classic oversold situation. The market threw the baby out with the bathwater during the tech sell-off. Atlassian's products are deeply embedded in enterprise workflows. Switching costs are high. Renewal rates are strong. The business is fine. The stock just got too cheap. Entry zone after the sell-off? This is one of the highest conviction contrarian plays on this list. If you believe enterprise software spending stabilizes and the cloud migration continues, Atlassian is severely mispriced. The risks? If enterprises cut back on software spending, Atlassian's growth decelerates. Also, competition from Microsoft Teams, Asire, Monday.com, and others could pressure market share. But Atlassian's ecosystem lock-in is strong. This is a buy-the-fear moment. The stock got too hated, the valuation got too cheap, and the business is still executing.
So there you have it, 5 momentum stocks to buy after the sell-off. Micron is your AI memory infrastructure play. Vertiv is the data center power and cooling winner. Riot Platforms is the Bitcoin leverage trade. Salesforce is the AI-powered enterprise software leader. And Atlassian is the oversold cloud collaboration opportunity. Here's my take. These stocks got hit hard enough that the risk-reward has shifted in your favor. If you're a momentum trader, these entry zones are what you've been waiting for. If you're building a growth portfolio, these are the names to accumulate. Which one are you buying? Drop a comment below. And if you found this breakdown helpful, smash that like button and subscribe for more momentum stock ideas Wall Street is sleeping on. See you in the next one.